What is up, everybody, and welcome back to another video. And if you are new to the channel, make sure you like the video and subscribe. But if you came across this video and you've been watching thousands of videos trying to find some way you can learn how to trade for free, but they end up just funneling you to their expensive course, I'm going to show you some ways you can become a successful trader. Because if you're cheap like me, you're definitely not going to want to pay $3,000 for a course if you don't even know if it's going to work out. So this is what I'm going to do. I'm not going to try to cram everything into one video because it's just going to be impossible. There's a lot to learn when it comes to this trading stuff. So what I'm going to do is teach you some of the basics and some of the common pitfalls that I always see that beginner traders will make. So risk management and position sizing. You don't know how many beginner traders that will either get a funded account and they think like, oh, all I just need is more money to be able to make this a career. And they end up blowing that account because they don't know what they're doing. They don't know the fundamentals and they end up putting all their capital in that first position size. And you're not going to be able to emotionally take that whenever you see a red. So stop trading from funded accounts, save your money, stack up your money so you can be able to open up a individual account and you can, start your trading career that way instead of doing a funded account and keep blowing it and wasting your money. It's not ideal for beginner traders. That company preys on, not gonna say the name, but those type of companies prey on beginner traders to lose money. That's how they become profitable. And only 12% of people that use funded accounts are profitable. The importance of risk management in stock. Risk management is the foundation of consistent success in trading, especially in fast-moving momentum markets. Even with a profitable trading strategy, poor risk management can lead to significant losses or even account blowups. The goal isn't just to make money, it's to stay in the game long enough to make money consistently. So small profit is some profit. Managing volatility and avoiding common pitfalls. Volatility is a double-edged sword. On one hand, it creates opportunity. On the other hand, it brings risk. Momentum traders often target volatile stocks because of their large price swings, but without proper mindset and management techniques, that volatility can destroy your account. Common pitfalls to avoid: over leveraging positions, risking too much on a single trade. That's what we talked about earlier. And I'm telling you right now, I always see it. Somebody will have $10,000 in their account and first position, they think that like stocks, they take you up to the moon, like I was with GameStop and AMC, and they put their entire 10,000 on the first position. So what I mean by that is that, you get your stock on the scanner, you type it in, and they're like, okay, and the first thing that they do, they see a stock that's $5, they put in 2,000 shares and they like, I'm gonna hold it and then it's gonna go to the moon. So you just put your entire account on your first position and you're a beginner trader, so you're not going to be able to emotionally take that once it goes the opposite way. Not using stop losses, hoping a losing trade comes back. So my strategy is momentum trading. So I use the scanner, I type it in, and I trade those big breakouts that you see at the beginning of the day where you see it happens between like 4 or 5 a.m. That's me trading. Instead of trading that support and resistance where you're bouncing off, support and it's only going up like 20 cents and you're barely making any profit. So I'm getting in before the party gets in. And I perfected this strategy to teach to beginners, to that way they're not mentally draining themselves with losing money or trying to figure out a perfect strategy that works for them. And there's a lot of strategies when it comes to this trading stuff where you have fair value gap, you have ICT, all that stuff. But this is the easiest way for a beginner trader to learn, because everything you get in your hand hold the entire time. The scanner is telling you what stock to trade. You don't have to worry about all these technical analysis. It's the easiest way to trade. That's why I got into it. So not using stop losses, chasing trades, entering late due to FOMO, fear of missing out. So if you see 3 big candles, every beginner trader should know that if you see 3 big candles, it's going to be a reversal because people are taking profits now. Revenge trading. I do see a lot of beginners like to revenge trade and they try to recover their loss and they end up losing more money. So when it comes to having a red day, cut it. Just take your red day and try again tomorrow, because that momentum has already died off. And then now you're going to be trying to trade the support and resistance, and it's only going to be like 20 cents from that reversal that happened that had like maybe a 50-cent reversal. Great traders know that capital preservation matters more than being right. They cut losses quickly and let winners run, because over time, controlling losses matters more than maximizing gains. So setting stop losses and profit taking strategies. A stop loss is an insurance policy. It limits how much you're willing to lose if the trade goes against you. Momentum trading is fast paced. So defining this before you enter the trade is non-negotiable. Type of stop loss is technical stop, below support levels and above resistance. And I know this is rumor going around where the market maker can see your stop loss orders. I don't know if they're ever going to admit that they can see retail trader stop losses, but I don't personally use stop losses because I keep my losses small anyway. And I'm trading pre-market, so you can't set stop loss orders in pre-market anyway. And I don't like trading market open because I think that it's way too volatile. The stock is just going up and down. And the momentum momentum has already kind of died off from that moment where you can profit a lot from, you know, pre-market where it was going up $3 or $4 in 4 minutes. Percentage stop, risking a fixed percent of a stock price. Dollar-based stop, based on how much of your account you are willing to lose. Profit taking strategies, scaling out. That's what I do. I scale in whenever I see a momentum trade. I'm scaling in. I'm going in with, you know, not my entire account. And once I feel like that momentum is dying off, and that's when I scale out of the stock. So scaling out, trailing stops, let winners run while locking in gains. Risk reward exit. If you risk $100 with a 3-to-1 ratio, exit a $300 profit. Always remember, plan the trade the plan, never wing it. Your trade should have defined entries, exits, and risk before you click buy. Position sizing determines how many shares you should buy on a trade. It's one of the most powerful tools you have to protect your cap and maximize returns. How to determine the right position size? Start with how much you are willing to lose per trade. A common rule is to 1 to 2% of your total account per trade. This ensures no single trade can severely damage your account. So the formula for this is position size equals account risk per trade. Risk per share, example, account size $10,000. Risk per trade 1%, $100. Entry price $50. Stop loss 48. Risk per share $2. Position size equals $100. $2 equals 50 shares. With this logic, even if your trade fails, you lose only $100, which is manageable and won't emotionally throw you off for the next setup, because you know trading is all psychology. You might be profitable from your simulated money, you know, paper money, but when it comes to real money, you're not going to be able to emotionally take that type of loss. Because I've seen people have a story where they said, oh, I was down $10,000 on my paper account and I held it for the whole day. We don't hold losses. We cut it off immediately because we're keeping our losses small. So he said, I held it for the whole day, and at the end of the day, I got the 10,000 back and I was up 30,000. Like, that's real life situation. That's never going to happen. You are not going to be able to emotionally handle that $10,000 loss. So that's why you're going to end up cutting that loss. This is why I kind of prefer people to use real money instead of simulated money, because you get the real-time action of the stock market. You're also using real money, your money, so you're going to be able to emotionally know, okay, is this a smart trade? Is it not? You know, and you don't have to use, you know, a large amount of real money. You can just do $10, you know, buy a share, just see how the stock market works in real time instead of doing the whole paper trader money. And you think that you're just already profitable from paper money because, you know, there's a 20-minute delay. It's just completely different from the actual real-time markets. So with this logic, even if your trade fails, you only lose $100, which is manageable, and you won't emotionally throw you off for the next setup. Risk reward ratios and capital preservation. Never enter a trade unless the potential reward outweighs the risk to reward ratio is a critical metric. For example, a 1-to-1 ratio means you are risking $100 to make $100. A 3-to-1 ratio means you are risking $100 to make $300. Good traders don't need to win every trade. Even a 40% win rate can be profitable with a 2-to-1 or 3-to-1 risk reward strategy. It's all about managing risk per trade and total exposure. So you need emotional discipline, staying objective in high volatile environments. Trading isn't just a numbers game. It's a psychology war with yourself. When you see a stock ripping up 20%, your heart might race. When you take back-to-back losses, frustration creeps in. Emotional discipline is what separates professionals from gamblers. The psychology of momentum trading and avoiding FOMO. FOMO is one of the most destructive emotions for momentum traders. You see a stock take off and you want to jump in, but you are too late. You chase, you enter at the top, and it reverses. Now you are bag holding or stopping out emotionally. So when I said before, where you see a momentum stock break out, you know, the scanner, it's an AI thing. So you'll hear the robot voice calling off the stock repeatedly, and you will be like, okay, well, there's already 3 candles up. I can jump into this stock and see if it can rip back up again, but it ends up not working out that way, because, you know, if you got into the stock earlier and you see 3 candlesticks going up, you're immediately going to want to take profit. You're not going to want to be those type of bag holders. So you're going to end up getting that reversal, and you're just going to end up taking a major loss. So discipline tactics, trade your plan, not your emotions. If you miss a move, let it go. There's always going to be another setup, because there's the breakout times where it happens at 4 a.m., 4:30, 5, and 5:30, and then you have your 6, and then you have your 6:30 market open. Journal your trades, write down your mistakes, write down what you did good, write what you're thinking or feeling, breathe, you know, take a breath. You're going to feel like this anxiety build up whenever you, like, there's going to be a bunch of emotions that you're going to be going through, because you're going to be like, okay, wow, I went up to get water and this stock broke up 200% while I was gone for like maybe 4 minutes. So you have to learn how to control your emotions and just take a breath. Managing emotions and sticking to your plan. Your edge comes from repetition, consistency, and calm decision making. Here's how to stay grounded. Define your entry, stop, and target before you enter, set alerts instead of watching every tick, have a daily max loss limit. If hit, walk away, focus on process over outcome. A good trade is one where you followed your plan even if it was a loser. Building emotional discipline takes time. You'll make mistakes. What matters is learning, adapting, and maintaining a mental clarity so that your edge can play out over hundreds of trades, not just one. So here's the final note. Risk management, position sizing. Risk management and position sizing aren't the sexy side of trading, but they are what makes careers, not just lucky streaks. Master these and you build the foundation for long-term success and momentum trading. So if you take these fundamentals in consideration, you will start to learn how to become a profitable trader. Now, if you're a beginner, you take these fundamentals and you apply it to your trading style. And the most important thing when what I did, I didn't want to pay for no expensive course. All these courses out here are $5,000, $10,000. That's why I made it $10 for you to, learn how the stock market works. And if it doesn't work out for you, and you don't like it, it's just $10. And the most important thing is that you need to have one mentor. You cannot have multiple mentors and you're watching all these videos and all these strategies because you're not going to be profitable that way. You don't know how many times like I said, I watched a lot of videos of all these traders, all these mentors, Ricky Gutierrez, Humble Trader, Warrior Trading. I watched all these people's strategy. I even watched Zed Monopoly. That was the first strategy that I had learned because, I was watching all these free videos instead of actually finding a mentor that was educated going that route. But like I said, it's too expensive. So just find a mentor that the strategy works for you. I like my strategy. My students like my strategy. So you can try my strategy out. It's just momentum trading. It's an easy way of trading. And this is just a small section from my course. If you guys want to learn more, you can just click the link in my bio and just sign up. It's only $10 and I went in a lot of detail with the stock market. So if you guys like the video, be sure to like, comment, and subscribe, and I'll see you guys in the next video.